Let's talk about the US dollar, the greenback, the buck, the world's heavyweight currency champ. For decades, it's been the star of the global financial system, but lately, it's looking shaky. The dollar's value is dipping against other major currencies, and that's got people talking. You might wonder, why should I care? Well, the dollar's strength affects everything from your morning coffee to your retirement account. A weaker dollar means pricier vacations abroad and more expensive imports, but it can also boost US exports. So, what's going on? In short, big players are selling dollars, lots of them. We're seeing massive coordinated moves by major financial institutions and governments shifting money out of dollar assets. When that much cash moves, it shakes the whole global system. The dollar has been the bedrock of international finance since World War II. Central banks hold it, oil is priced in it, and it's the default for global trade. But now, new economic powers are rising, technology is changing the game, and the old rules are being challenged. This isn't just a blip, it's a sign of a much bigger transformation in the global order. The dollar's stability is no longer a given. Understanding why the dollar is weakening is crucial, because it impacts everyone, not just Wall Street. The world is shifting, and the dollar's role is being redefined. And that's something we all need to watch. So who's leading the charge away from the dollar? The answer: Europe and Asia. It's not just individuals but massive institutional investors and governments. European pension funds managing trillions are quietly reducing their US investments, converting dollars back to euros. They're nervous about the US economy, politics, and Fed policy, so they're hedging their bets. In Asia, central banks, especially in China and Japan, are the big players. They've historically held huge amounts of US government debt, but now they're diversifying, selling off US bonds and looking elsewhere. This isn't a panic, it's a slow, calculated retreat. Think of it as the party winding down. Everyone's calling a cab, not running for the exits. These institutions are making strategic moves, seeing a world where the US isn't the only game in town. When the world's biggest investors start shifting, everyone pays attention. The dollar's dominance is being quietly but steadily challenged. This is a global, coordinated move, not just a few people cashing out, and it's changing the financial landscape. What are these investors actually selling? Not stacks of cash, but digital financial assets, mainly US stocks and bonds. European investors are pulling out of US stocks, especially tech giants, and moving profits back to euros or other markets. Concerns about high valuations and regulatory risks are driving this shift. Asian central banks, meanwhile, are focused on US Treasury bonds. For years, buying treasuries was a safe bet, but now, geopolitical tensions and America's ballooning debt make them riskier. These central banks are slowly reducing their holdings, either selling off bonds or not reinvesting when they mature. The result? A double whammy. Europeans sell stocks, Asians sell bonds. Both mean selling dollars. It's a pincer movement, squeezing the dollar from two sides. Different assets, different motivations, but the same outcome: less demand for the dollar, more supply on the market. This is the engine driving the dollar's decline. The world's biggest investors are saying, "Thanks, America, but we're diversifying." The sell-off is deliberate, not panicked. It's a fundamental shift in global finance. The dollar is losing its status as the automatic first choice, and that's a big deal. Let's zoom in on the institutions making these moves. European pension funds are financial giants, managing retirement savings for millions. Their goal is long-term stability, not quick profits. For years that meant investing heavily in US stocks. But now, with US political and economic uncertainty, they're reallocating billions away from American equities. Even a small shift, just a few percent, means tens of billions of dollars moving out. Asian central banks, like those in China and Japan, are a different breed. They hold vast reserves of US dollars as economic insurance. Buying US treasuries used to be a no-brainer, but now it looks like a vulnerability, especially for China. Geopolitical tensions and the desire to promote their own currencies are pushing them to diversify. Japan too is feeling the pressure as US interest rates fluctuate, making their bond holdings volatile. Both are slowly reducing their reliance on US assets. These moves are cautious, but they add up. The world's financial giants are rebalancing, and the dollar is feeling the impact. This is a strategic long-term shift, not a knee-jerk reaction. The numbers behind this sell-off are staggering. Recent data shows hundreds of billions of dollars flowing out of US assets in a single year. In one quarter alone, foreign investors sold a net $100 billion in US stocks, a dramatic reversal from previous years. That's more than the GDP of many countries. When that much money leaves, the market feels it. On the bond side, China and Japan have reduced their US Treasury holdings by hundreds of billions. They're not dumping everything at once, but the trend is clear, a slow, managed retreat. The cumulative effect is a major headwind for the dollar. The dollar's share of global reserves has dropped from nearly 70% a decade ago to below 60% today. That shift represents hundreds of billions moving into other currencies. This isn't just a market blip, it's a structural change. The world's biggest investors are betting less on the dollar's supremacy. The financial landscape is evolving, and the dollar's dominance is no longer a given. Why are investors moving away from the dollar? It's a perfect storm of factors. First, interest rates. The US used to offer higher returns, but now, as other central banks raise rates, the gap is closing. Holding euros or yen isn't as costly, so investors are less motivated to take on dollar risk. Second, technology. The rise of digital currencies, especially central bank digital currencies like China's digital yuan, threatens the dollar's role in global trade. These new systems could bypass the dollar entirely. Third, geopolitics. US financial sanctions have made countries wary. When Russia's assets were frozen, it sent a message. Your money isn't safe if you cross Washington. This weaponization of the dollar is pushing countries to seek alternatives. It's not just about economics anymore, it's about sovereignty and security. All these forces are eroding trust in the dollar. The world is looking for new options, and the dollar's grip is loosening. There's also a coordinated movement to challenge the dollar, led by the BRICS nations: Brazil, Russia, India, China, and South Africa, plus new members. These countries represent a huge share of the world's population and economic growth. Their goal: reduce dependence on the US dollar. They're promoting local currencies for trade. India and the UAE, for example, now settle deals in rupees and dirhams. China is making similar moves across Asia and South America. Each deal chips away at the dollar's dominance. BRICS is also building its own financial infrastructure, like the new development bank and a potential alternative to SWIFT. This would insulate them from US sanctions and create a parallel system. The dollar's incumbency is strong, but the goal isn't total replacement, it's a multipolar currency world. The push is slow, but steady. The dollar is no longer the only option, and that's reshaping global finance. So what does a weaker dollar mean for you? Globally, it's a double-edged sword: easier debt repayment for some countries, but more uncertainty and volatility for everyone. Commodity prices like oil and gold, usually priced in dollars, could rise, fueling global inflation. US assets become less attractive, so the government may have to offer higher interest rates to attract investors. That could slow the US economy, with ripple effects worldwide. For Americans, a weaker dollar means less purchasing power abroad. Travel and imports get pricier. Everyday goods, from wine to electronics, could cost more, adding to inflation at home. But there's an upside. US exports become cheaper for foreigners, which can boost American manufacturing and jobs. For the rest of the world, it's a mixed bag. Some benefit, others lose. The dollar's value isn't just a number, it's a key part of the global economic machine. When it shifts, everyone feels it. Businesses, governments, and consumers all have to adapt. The winners and losers change, the world economy gets more complicated, and everyone needs to pay attention. So, what's the bottom line? The dollar faces its biggest challenge in decades. This isn't a wild prediction, it's a real trend, driven by the world's largest investors. European pension funds are moving away from US assets. Asian central banks are moving away from US assets. They're reacting to shifting interest rates, new technologies, and a riskier geopolitical landscape. The dollar won't collapse overnight, and the US still has major strengths. But this is a slow erosion of dominance, not a sudden fall. We're moving toward a multipolar currency world. For investors, it means rethinking old assumptions. Diversification is now essential. For US policymakers, it's a wake-up call. The privilege of reserve currency status can't be abused. For everyone else, understanding these shifts helps make sense of rising prices, market volatility, and political debates. The dollar's slow decline is shaping the future of the global economy. It's a story unfolding in real time, and we're all part of it.